You say that the world has gone mad and the system, meaning capitalism, is broken. You point to things like the wealth gap and the printing of money and monetary policy, unfunded liabilities. What are we going to do about it?
Well, let's first touch on what it is, okay? The necessity of trying to be stimulative when there are not other monetary policies. You can't lower interest rates anymore. There's been a lot of printing of money. And as a result of that printing of money, investors are very flush with money. And as a result, they're taking very low returns. And they also are buying dreams rather than earnings in stocks. So we've pushed that to an extreme in terms of those returns. And then at the same time, it is clogged with investors. So investors have an abundance of money. And then we also don't have much in the way of the trickling down. So we do know that we have populism of the left and populism of the right. And we're going to come into a period of time where that's going to be more challenging. And it'll have big effects on the markets because it'll have a big effect on tax policy, but it'll also have a big effect on how we are together. So if I take those things, the large populism of the extremes and the battle between those two, and then I take the absence of effective monetary policy and the conflicts that we're having in the world, that's the nature of that market. So I believe that we would need to have smart togetherness to engineer a process by which the system works better to produce more equal opportunity and also can raise the size of the pie because there are a lot of good investments in education. If we're underfunding education, or if we're doing a number of things that could produce high return on investment, we'll be better off. And so that's my basic perspective. And then also I'm pointing out that the pushing to negative rates, we're running out, and that's going to lead to fiscal and monetary coordination necessity. That is very dangerous. We're going to have large budget deficits, large debt. We're going to need to fund those liabilities that we have. We have pension liabilities and health care liabilities. That means there's going to be a lot of printing of money, and what that looks like is important. So that's what I'm saying. The system is not working efficiently, monetary and fiscal policy, and the means by which there's equal opportunities not working efficiently at a time when we have the circumstances we have.
So whose responsibility is it then to fix it? You pointed out a very scary situation here. Is it corporate America's responsibility to fix it? Is it the government? Is it individuals in this country through philanthropy? Who's going to solve this?
I think it can't be done in a fragmented way. I would say the leadership, whether it's the president or the state leaderships and governors and so on, has to take an approach where it's a come-together approach of different types of people. I'm not saying this is likely. I'm saying it's necessary because we're going to a war-like environment. And so the smart people who are in contact with various on-the-ground needs to realize that they have to engineer it together to make sure that our economy works well. Education, for example, if you look at the education statistics, we have to improve education. It's a hell of an investment. So I think that's the nature of the beast, that it has to be top-down directed. It's got to be coordinated. It's got to be nonpartisan or bipartisan. And I don't think that's likely. I think what's most likely is that as we move ahead, there'll be more printing of money that's necessary to fund those deficits. There will be bad returns because they'll be driven down, and that the dreams of selling companies that no longer, they're selling dreams, they're not selling earnings, and they're not even selling a path to earnings, that those things will have to be normalized, will have to be rectified. Time will produce a paradigm shift. There'll be a paradigm shift where those things that supported the economy and the markets in the past will increasingly be in jeopardy.
Now, in the last, few years, we've seen, obviously, on the fiscal side, tax cuts. We've seen on the monetary policy side, we're now in a lower interest rate regime. Would you recommend reversing some of those things to accomplish your goals? Do rates need to go higher from here?
No, I think the system is pretty much stuck. You can't raise rates because as a result of the stimulation, companies and various entities have a lot more debt. So it's stimulated. The borrowing and the purchases of companies back with borrowed money and all of those things have produced a stimulus. You know you can't, if you do reverse it, it will have the effect of causing prices to go down. Let's say if we reverse the tax cuts, okay, and we're looking at different proposals. The proposal to reverse the tax cut and change Elizabeth Warren's, for example, would result probably in about a 15% change in earnings. That would be a 15% change in tax, the value of stocks and earnings. So each one of those things, if you reverse them, you're going to reverse some of the things that happen, and that has enough consequences. So I think you have to engineer things carefully. I think that there's lots of good investments that can be made in some things. That we're going to need to raise taxes. But the question is how it's well engineered and whether we're doing that in a bipartisan and a nonpartisan basis. There are no simple answers because when we run out of monetary policy, we've run out of the stimulant that we usually can go to deal with that situation at the same time as there's this polarity.
Ray, I think we have a question back in the studio at the NYSE. Never mind. So your Pure Alpha fund lost more than 2% this year, which has largely been attributed, at least in reports, to Bridgewater's bet on government bonds. I know you've said that interest rates, low interest rates are bad, but at this point, as an investor, can you fight them? How do you?
No, I'm not trying to fight them. And by the way, it's been misattributed to what it is. We're down about 2%. We've made money in 18 of the last 18 years. We hope we make money this year, too. That's in Pure Alpha. The all-weather fund is up about 14% or something, just to be clear. And we don't ever claim to make money every year. But in any case, if you want my thoughts on markets, I'd be happy to give you thoughts on markets. But I'm not going to talk about positions.
Well, let's get your thoughts on the markets because yesterday, once again, stock markets hit a record high. They're up today, could likely close again at another record high. Do you think this is an overbought territory, or do you think that this is kind of a breakout territory for the equity markets?
There's the amount. I don't think it's a breakout. And I don't think it's particularly overbought either, because what you have is the weight of money. There's a certain amount of money out there, a lot of money. Central banks bought $15 trillion of assets and so on. So we have a lot of money. And the question is where that money goes. And if you look at the short-term interest rate and you compare what is the bond yield with that, or you compare that with what our expected equity returns are based on risk premiums, the whole returns of asset classes have gone down to very, very extremely low levels. All asset classes have gone down to those levels. So that discounting has happened, and that lower tax cuts has largely happened. And so that's the nature of the dynamic. As long as that remains the dynamic, a lot of the good things are behind us, and there's no reason to disrupt the bad things right now. At some point, though, as we're going forward, there's going to be bigger deficits, and you're going to have to fund it. And so we're dealing with almost a currency issue, longer term, in terms of what is the value of currency when those liabilities, not only the debt liabilities, but the pension liabilities or the health care liabilities, which are like debt, they're promises that have to be paid. They will either be paid by higher taxes or they'll be not paid and defaulted on. I don't think they will be defaulted on. I think by and large they're going to be paid. But if they raise taxes too much, then it changes the nature of that economics. So, for example, profit margins have gone from about 7% of revenue to about 14% of revenue, that increase in profit margins. I don't think we're going to see that same type of increase in profit margins because it has to do with the compensation as a percentage of revenues declining. So the mere mechanics means that there's not a lot of new things that are going to push it higher in the way that it was pushed higher. And there's not a lot of negative things in that way. So the big negative will be a gradual, I think, monetization of debt when we have a lot of debt. And that'll have an implication for currencies, and it'll have an implication for capital flows. But as long as there's a lot of money trying to find something and it all competes with it, then we're going to deal with low returns going forward. But it doesn't mean price falls.
But what does that mean for excesses out there? If you have all that liquidity?
It means, of course, enormous amount. It's not efficient resource allocation in the same way, right? Because it's financial engineering again. It's like if you could borrow at negative interest rates, okay? And it's not even the borrowing at the negative rates. A lot of these deals mean that you don't even have to pay back the principal. The idea basically is, for the most part, you can roll over your principal. And so that means you're giving money, okay? And that means investors, why are they giving money away? They're giving money away because they got too much money. And then because the other asset classes are priced off of the other, and they don't have a commitment for any particular level, you're selling dreams. So that is not economic allocation of resources, but it's not the same thing as a bubble that's going to burst like 2007 and 8, when those debts came due and there was no rollovers of that debt. That produced the financial crisis we were able to anticipate in 2007. We did well in 2008. That is not what we have today. We have today really a big squeeze happening.
What does that mean, a big squeeze?
A big squeeze means that gradually more obligations come due. If we take the amount of debt, combine it with the amount of pension obligations, and combine it with the amount of health care obligations, which need to be met or defaulted on, that we have a lot coming at us. We have large deficits, and therefore and we don't have an effective transition of monetary policy. So when all those purchases of financial assets, they don't trickle down in the same way because we don't have as creditworthy borrowers on the lower spectrum of the lower income levels. Let's say the bottom 60%. If I take the bottom 60%, the majority of the population, and I look at their creditworthiness and their incomes and their circumstances, they're difficult to lend to in terms of that creditworthiness. And so you don't buy the bonds. So that system in itself creates an inefficiency. Like you put a lot more money into the financial system. It stays in the financial system. It does not have the traction that is normal to get the other spenders. A lot of the key is at the top, they don't spend. If you have a high income person or a wealthy person and you give them more money, or if you give a pension fund, or if you put more in the financial system, it'll stay in the financial system. And when it doesn't go down and have that same sort of traction in the economy, it creates a sluggish economy. That's a worldwide phenomenon, that it's not just in the U.S. So if we're taking other countries, I can go around the world. I can take Europe. It's the same situation. China, in a greater extent, is a great situation. They're all facing something similar. And because they're all connected, so that what we do with China in trade, or what we do with Europe in trade, or even their importation, because their economy goes at a slower rate, they're going to import less. And capital flows, they're all connected. So because it's weaker there, it's weaker here. So you have this kind of sluggishness in which if you rev it up again and you stimulate it, you'll just spin the wheels. You'll put more in the financial system. So that's the mechanisms that are affecting the nature of the markets and the economy.
And a big piece of that, of course, is income inequality, a topic that you have been writing about for quite some time now. And I want to play for you a soundbite from Lee Cooperman, who was on CNBC yesterday. He was talking about income inequality and how it's created this vilification of billionaires out there, especially by that of Senator Elizabeth Warren. The focus turned to you and income inequality, which you've previously called a national emergency. Take a listen.
Winston Churchill said it well. He said, you don't make poor people rich by making rich people poor. Okay? He also said, as a paraphrase, the main vice of capitalism is the uneven distribution of prosperity. The main vice of socialism is the equal distribution of misery. I respect Ray Dalio. He's a man that, like myself, took the Giving Pledge, I believe. He's done very good things with his money. I don't think he's recommending socialism.
These are unfunded liabilities.
I'm not recommending socialism.
Okay, we could have made some news.
No, I'm not recommending. I am recommending the re-engineering. We have a problem. The problem has to do with really equal opportunity. And because you have to create productivity to raise wealth. You can't just disrupt that. You have to create productivity. And we can create a lot of productivity to raise wealth and divide the pie well. So you have to increase the size of the pie and divide it well. So I'm just an engineer, right? I understand how markets and economics work. I also realize that the system is not producing equal opportunity. I really want to emphasize equal opportunity because there is the American dream. The American dream, which I was fortunate enough to live, is can you have something approaching the good guidance of parents ideally, on values, the development of character, and then together with that, education, and then you come out to a market in which there's equal opportunity. That's America's greatest strength. I agree with Lee Cooperman in terms of the notion that when you can make your dreams come true. The other thing you have to understand is that most billionaires have not worked to become billionaires. What they did is they produced things that people wanted. Okay, I didn't try to make. I fell in love with the game of the markets, and I made the market money. I made different people. Steve Jobs loved the game. Most people are doing it because they love the game, and then they produce things that other people want, and that makes for a better society. So I think the key question is, I'd like to almost ask the audience. Are billionaires exploiters of the system to the detriment of the system, or are they contributors to the system to betterment of that? In any case, when we fight each other, when it's terrible to demonize the other side, if we instead say, how do we work together and understand and empathize so that we can deal with this together, that's going to be the key.